2008 crisis put the whole world into recession.
Down 1.7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
Let's talk about the speed with which we are watching this market deteriorate.
We're red everywhere, essentially, down by 4-5%.
We're down over 16%.
Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Traders here working the phone say a lot of their customers are freaked out, waiting to see how low the Dow will go. They're focused on the Dow, not so focused on OPEC. Yes, OPEC did cut production by 1.5 million barrels per day.
The heightened financial turmoil that we have experienced of late may well lengthen the period of weak economic performance and further increase the risk to growth.
The primary reason for such a big crisis was the bad loans given by the banks. But were the banks only responsible for the crisis? What was the government doing until the crisis got so big? In this short documentary, we'll see the crisis from start to end. And along the way, we'll also see the stories of men who saw it coming and made insane profits. The real crisis started in the late 90s and early 2000s. Around this time, the government told banks to provide credit to low and moderate income people. The aim of the government was to make things affordable for the lower income class. So banks continued this practice of lending to such people. Before the 1990s, banks were very cautious about to whom they lent money. During those times, banks would give out loans and then hold these loans on their books until they were paid off by borrowers. But in the 1990s, the government passed a securitization law. This law changed everything about how banks dealt with mortgages. According to securitization, banks were giving out loans, but now instead of holding the loans on their books, the banks could sell that loan immediately to an investment bank. This made the bank recover its money right away. The investment bank used to buy millions of these loans. The investment bank then used to convert these loans into another product named mortgage-backed security. These MBS were then sold to investors who put billions of dollars into these MBS. This dramatically changed the incentive structure for the original banks that issued the loan. Once they sold the loan, their risk was transferred. Because of this, banks no longer had a strong incentive to ensure the loan was good, because they wouldn't suffer even if the borrower defaulted. Their profit came from selling the loans and the fees they earned for giving out the loans. This created a powerful push for banks to make as many loans as possible. By the way, to understand the core issue of the 2008 crisis, you need to understand what MBS, mortgage-backed securities, CDO, collateralized debt obligation, synthetic CDOs, and CDS, credit default swaps, are. All of this I will explain in this next part, so pay very close attention. In the mortgage-backed security, the loans were arranged in layers according to the quality of the borrower. Here's a quick example of how these MBS were created.
Let's say 10 people have taken a loan from ABC Bank to buy a house, and they owe money to ABC Bank. Now, what ABC Bank does is sell these loans to an investment bank. Now people owe the money to the investment bank. The investment bank combines these loans and creates new products known as mortgage-backed securities. This process is known as securitization and allows investment banks to transform a portfolio of individual loans into a tradable security. This product is then sold to investors. Investors trust these mortgage-backed securities because they're considered one of the safest investments, as everyone pays their home loans to own a house. These home loans are the fundamental part of these mortgage-backed securities. In mortgage-backed securities, these loans are rated by rating agencies like Moody's. The rating is done according to the behavior of the borrower. It is called a tranche. For example, if a borrower pays the premium on time and never misses any premium, the probability of such a borrower paying back the loan is higher, so such loans are typically rated higher. These loans are rated as AAA loans. Another type of borrower might miss some of the premium here and there, but at the end he will pay back his loan. He may pay it a little late, but in the end he pays it back, and this type of borrower is slightly riskier than the previous type of borrower. So, such loans are rated a little lower. These loans are rated BBB. And the third type of borrower might default on his payments and not be able to pay back his loan. Such loans are rated lower, and they are rated as CCC loans. Now, when an investor invests in such mortgage-backed securities, they first check the overall ratings given by the credit rating agencies to these mortgage-backed securities. If a mortgage-backed security had a higher number of AAA loans, it was considered a safer investment by investors. But there was another problem because investment banks and credit rating agencies were hand in hand. The credit rating agencies never gave the true rating to these loans. For example, if the loan actually had a rating of CCC, but the credit rating agencies ignored that and gave it a rating of AAA. So all these mortgage-backed securities were rated higher because of these fraud ratings by credit rating agencies. Because of this, investors thought these mortgage-backed securities had the majority of AAA-rated loans, but instead they were all filled with the majority of CCC-rated riskier loans, which made these mortgage-backed securities much riskier than investors thought. This whole process was very beneficial for the banks. Banks would just give out loans, and then they would sell these loans to the investment bank. The investment bank would then just create mortgage-backed securities with these loans, and credit rating agencies would rate them higher. Then it was sold to investors as a safe investment.
The complexity of the 2008 crisis didn't stop with just MBS. Investment banks found a way to take the riskiest, often unsold, portions of these MBS and repackage them into an even more complex and dangerous product, the collateralized debt obligation, or CDO. This strategy allowed them to offload immense risk from MBS to even more risky investment products. Let's quickly understand how these CDOs were created.
If the mortgage-backed security has more AAA-type loans, then it is considered a safe bond. However, investors could bet money on each layer or tranche separately. For example, if an investor does not want to take much risk, he would bet his money on the AAA-type safest tranche, and the returns on those tranches were very minimal. If the investor bets on the BBB tranche, which is riskier than the AAA tranche, then they would get a much higher return on their investment. And if an investor wanted to bet their money on the CCC tranche, then their return on the investment was much higher, as they had the riskiest loans. This was the normal mortgage-backed security bond. To create a CDO, banks use another trick. As investors were investing billions of dollars into these bonds, they mostly used to invest in the safest tranches of the MBS product, which are usually AAA or BBB tranches. The majority of these CCC tranches and these mortgage-backed securities would remain unsold. Let's say there are two MBS products, M1 and M2. Each product has AAA, BBB, and CCC tranches. Investors now invest in AAA and BBB tranches of M1, and in M2, they only invest in AAA. So the CCC tranche from N1 is unsold, and the BBB and CCC tranches from M2 are unsold. So banks used to combine these unsold tranches from both MBS bonds into a product known as collateralized debt obligation, or in short, a CDO. In the CDO, the loans from the unsold tranches were arranged in different tranches. These tranches were typically labeled as senior, mezzanine, and equity tranches. The senior tranche was the least risky and considered the safest. The mezzanine tranche is riskier than the senior tranche, but offers higher potential returns. The equity tranche was the riskiest, and it offered the highest potential returns, but was the first to absorb losses if the underlying assets in this tranche performed poorly. As explained earlier, these CDOs were made up of BBB and CCC unsold tranches from MBS. So the rating of the overall CDO should not be more than BBB. However, the rating agencies gave AAA ratings to such CDOs. As you know, these CDOs were completely filled with tranches investors did not want, but the rating agencies still gave them higher ratings. Because of this, the investors thought these CDOs were also safe investments. Similarly, if the lower tranches of these CDOs are not sold, banks would combine the unsold tranches of other CDOs and make a new CDO that was just a CDO of a CDO.
As these complex products, both MBS and the newly created CDOs, flooded the market, a few skeptical investors began to see the cracks forming. They wanted to bet against this system, but there was no direct way to short the housing market. This led them to a powerful financial instrument, the credit default swap. These swaps were very valuable and in huge demand at the peak of the crisis. Everyone at that time was trying to get these swaps. Let's understand how these credit default swaps work. Basically, these swaps are like insurance. It's better if we see a simple example of these swaps with friendship default swaps. It's the same as credit default swaps, just the name is different.
Let's say there are 3 friends, Kevin, Mark, and Daniel. Mark wants to buy a car, and he asks Kevin to lend him $30,000. Mark agrees to pay back Kevin with an annual interest rate of 5%. Kevin lends Mark the money, but he's also worried that if Mark faces financial difficulties, then he might not pay him back. So Kevin wants to secure his investment. He goes to Daniel and convinces him to make a friendship default swap contract with him. According to the contract terms, Daniel will pay Kevin $30,000 if Mark fails to pay him back. Until then, Kevin will pay Daniel a monthly premium of $300 for friendship default swaps. As all 3 were friends, Daniel knew Mark very well, and he knew that Mark was a financially disciplined person. So Daniel thought that Mark would never face any financial difficulties, and thought that whatever premium Kevin was offering to him was free money, and he would never have to pay Kevin the $30,000. Eventually, Mark faces some financial issues, and he's unable to pay Kevin. This triggers the friendship default swaps contract between Kevin and Daniel has to pay $30,000 to Kevin. This contract was the same as credit default swaps.
Now that we understand the details of mortgage-backed securities, repackaging of CDOs, and the betting instrument of credit default swaps, we can truly appreciate the vision of the individuals who saw the cracks forming long before anyone on Wall Street. As the housing market continued rising, fueled by an endless appetite for MBS and CDOs, but as this was happening since the early 2000s, nobody was noticing it except some investors, such as Michael Burry. In early 2003, Michael Burry noticed that banks started to give out more interest-only mortgages. These were the mortgages in which the borrower only paid the interest amount for the first few years of the loan. It made the loan affordable for borrowers. After the first few years, you had to pay interest and principal as well. So for the first few years, if you were paying $500 per month, after the interest-only period ends, then you would be paying $1,100 per month. Throughout 2003 to 2004, Burry observed that such loans were given in huge quantities. In 2005, he got serious and he studied the individual mortgage bonds these loans were added to. Michael Burry drilled down to the individual loans to study them and figured out that the majority of the loans added in the MBS were low-quality subprime loans. Burry studied these loans so meticulously that he correctly figured out that the actual fall of the housing market would begin in 2007. His logic was that the majority of subprime loans had their interest rate adjustment in early 2007. So he figured out when the interest rate would be readjusted, and then the borrower wouldn't be able to pay the higher premium and would default on the loan. At this point, Michael Burry made a plan to profit from this mess. His plan was to short the housing market and bet money on its fall. At that time, there was no direct method to bet money against the housing market. So, Burry decided to use credit default swaps, CDS, to short the housing market. But there was one problem Michael Burry saw. Even if he bet money on the housing market with the banks, the same banks were selling these MBS products to investors, and Burry was betting money on their product that it would fail. Once it failed, the banks would be bankrupt and they wouldn't pay him. For this reason, Michael Burry also studied which investment bank had maximum exposure to these bad loans. He figured out Lehman Brothers and Bear Stearns were exposed too much and they might collapse. Now, to execute his plan, Michael Burry went to many banks, such as Goldman, Deutsche Bank, and Bank of America, and bet money against the housing market with the help of swaps. Those banks really believed that the housing market would always remain stable and never crash, so they thought Michael Burry was a fool and gave them free money. Burry was so convinced about Lehman and Bear Stearns that he didn't even bother to go to them. To mitigate the counterparty risk, Burry deliberately used 6 banks in total to sell him CDS contracts. While Michael Burry was making his short positions, one more person was getting suspicious about the housing market. It was Greg Lippmann, also known as Jared Vennett from The Big Short. Greg Lippmann worked at Deutsche Bank as a bond trader. In 2005, he noticed increasing default rates among subprime borrowers, which gave him an idea that something was wrong, but he wasn't convinced that the housing market would crash. While Michael Burry was buying swaps from various banks like Goldman and others,
all the credit default swaps were sold by a company named AIG, and those swaps were bought by Michael Burry. Goldman acted as a middleman between these two. AIG sold around $20 billion worth of swaps every year, and Goldman got a 2% commission for selling through them, which was about $400 million. When Deutsche Bank saw that AIG was selling these credit default swaps and Goldman was earning these huge commissions, they also wanted to be a middleman to earn those huge commissions. At the time, investors were hesitant to bet against the housing market because everybody thought it was stable. So, Greg Lippmann, aka Jared Vennett's bosses at Deutsche Bank, came up with an idea and asked Lippmann to pretend that he does not believe in the stability of the housing market and that it will crash. Do note that the higher management at Deutsche Bank did not believe that the housing market would crash. They just wanted to show AIG that they also have buyers for credit default swaps, and that AIG should also sell through them and pay them a big fat commission. Lippmann was a bond seller and buyer at Deutsche Bank. When his bosses asked him to bet against the housing market, he did it initially, even though he didn't believe that it would crash. But Deutsche Bank wanted to earn more commissions. So Lippmann had to find more people who were ready to bet against the housing market. To pitch the idea properly to potential investors, he assigned his quantitative study guy to the housing market.
That's my quant.
What?
My quantitative, my math specialist.
When Lippmann saw the results of the quantitative guy's analysis, he figured out that the housing market did not even need to collapse. Even if housing prices stop rising so fast, it will still make a profit on those credit default swaps. As the bank guys had given out many bad loans, these loans were rated higher than their true ratings by the credit rating agencies. For example, if the loan has a rating of CCC, the credit rating agencies rate it as BBB. As these loans were not given true ratings by the credit rating agencies, when they started to default, nobody had any idea that these loans would crash the market. Lippmann's analysis showed that the loan default rate is about 4%, and if the default rate reaches 7%, then all the BBB minus rated loans will go to zero. And if the default rate goes to 8%, then the next level rated loans, which were BBB, will go to zero. After this, Lippmann knew the housing market was going to crash. He wanted to make money by betting against the housing market. But he bought the short position against the housing market and was paying a premium of $20 million. He wanted to reduce his premium and risk. So he wanted more investors who would invest in credit default swaps. Lippmann thought he could make more money through this. His idea was that he would convince investors to bet against the housing market and charge them a huge fee for buying and selling those swaps. The investors would happily pay his fee because they would be making so much money that Lippmann's fee would look like peanuts in front of their profits. This very thing is explained by Jared to Mark Baum and his team in this scene. So he started pitching his ideas to other hedge fund managers to invest money in credit default swaps. Lippmann met with so many people and investors who he thought would be interested in shorting the housing market. The people at the time thought the housing market was too stable and could never crash. That's why even after Lippmann showed and explained to them the potential crisis, they all agreed with his theory, but nobody took the bet. He got a rejection from all of them. Most of them cited the reason that it is not their job to short the housing market. After meeting up with so many of these hedge fund managers and investors, he realized that the people who ran funds specializing in mortgage bond trading were least likely to see the potential crash he was trying to explain to them. So he went to look for an investor who had done investments against the housing market in the past. Looking for such people, he found Steve Eisman, aka Mark Baum.
Steve Eisman was already doubtful about the stability of the housing market because of the high level of delinquencies in the subprime market. Then Greg Lippmann pitches his idea of betting against the housing market.
Before becoming a hedge fund manager, Steve Eisman initially worked as a corporate lawyer. His parents were working as brokers at Oppenheimer Securities, and they told Steve that if he wanted to learn about Wall Street, then the best way was to work as an equity analyst. Eisman started to work as an equity analyst. As an equity analyst, it was his job to analyze stocks or securities, evaluate them, and provide insights on publicly traded companies and their stocks. So his primary role was to research, analyze, and make recommendations about stocks and investments to help investors, fund managers, and financial institutions make informed decisions. When Steve Eisman started working as an equity analyst, nobody on Wall Street cared about the opinions of the equity analysts. But Steve Eisman was different, and he was known to make noise. While working as an analyst, he came across one company that used to give loans to people who were not financially stable. Basically, the company was in the business of subprime mortgage lending. Eisman studied the company and gave it a sell, or you can say a negative rating. Everyone on the Wall Street did not believe him, but eventually that company went bankrupt. Since that point, Eisman has been very well known on Wall Street. Steve Eisman was not afraid of going against the crowd and public opinion. This same trait helped Steve Eisman foresee the issues in the subprime mortgage lending that led to the 2008 financial crisis. Since the beginning, Eisman knew that there was something wrong with the subprime housing market, but he wasn't sure exactly what it was. When Eisman hired Vinny Daniels, he told Vinny to research the subprime market and figure out exactly what was wrong with it. Vinny did not understand the housing market at the beginning, so it took him 6 months to study the market. When he was done with his research, he found all these companies lending money to risky borrowers were growing super fast, but their earnings were mostly based on accounting tricks. They were like Ponzi schemes, needing more and more money to keep going. In 1997, right in the middle of the economic boom in the US, Eisman wrote a report based on Vinny's findings. In that report, he blasted all those companies. Nobody on Wall Street believed Eisman's report, but many companies that Eisman bashed in his report went bankrupt in the next year, and Eisman again proved himself as someone who goes against public opinion. After learning about the subprime housing market, Eisman decided to start his own fund, but initially he couldn't find anyone to invest with him. After lots of struggle, he found an insurance company that gave him $50 million. It was not great, but at least it was a start for Eisman. As Eisman had a different way of thinking than everybody else on Wall Street, he also attracted people in his team who shared his enthusiasm. The subprime lending market was all about lending to people with lower credit scores. In 1990, this market was a $30 billion industry, but by 2005, it had become a $625 billion industry. This was alarming because it meant a massive amount of money was being lent to high-risk borrowers, and the terms of these loans were becoming even riskier as more of them had adjustable interest rates, making it unclear how much borrowers would owe in the future. This surge in subprime lending was happening even as interest rates were rising, which defied logic and raised concerns about the financial system's stability. When banks were offering these loans to high-risk borrowers, and when these borrowers couldn't repay these loans, instead of learning from this and not giving out any more bad loans, the banks started giving more of these loans to such borrowers, and then selling them to the big banks on Wall Street. Banks like Lehman Brothers, Morgan Stanley, and Bear Stearns bought these loans. As Eisman understood the housing market and was also familiar with the Wall Street banks, he had a gut feeling that the subprime market industry was going to collapse. When Jared Vennett, aka Greg Lippmann, met with Steve Eisman and his team, they didn't trust Lippmann. Studying the bond market for a long time, Steve and his team realized that they could trust no one in the bond market. At the time, in the regular stock market, everything used to happen on computers, and people could easily trace the value of the stock from the charts and find out if anyone was betting against them. The bond market used to run like the old days without computers, and there was always fear among the bond traders about whether they got the right price or paid more for certain bonds. It was very difficult to find the actual value of the bond, so Steve and his team were very suspicious of any offers from the bond markets. When Steve Eisman first met Greg Lippmann, aka Jared Vennett, Eisman was already betting against the companies that originated subprime loans and the companies that constructed the houses. However, he was not completely satisfied with this method of betting against the housing market because it was expensive and much riskier for Eisman. Before meeting Greg Lippmann, Eisman did not know anything about credit default swaps. but Greg Lippmann explained to him the significance of credit default swaps, which convinced Eisman and made him invest in those swaps.
Similar to Burry, Lippmann, and Eisman, there was another group of guys, the Cornwall Capital guys. They also came to know about Burry's CDS strategy. Cornwall Capital's core strategy was to find asymmetric bets, opportunities where the potential upside was far greater than the downside risk. They looked for situations where the market had fundamentally mispriced an asset due to a misunderstanding of risk. They read Grant's Interest Rate Observer article published on October 6, 2006. This specific article detailed the inherent weaknesses in subprime mortgage-backed securities and collateralized debt obligations, CDOs. It laid out how even the highly rated tranches of these CDOs could be wiped out with relatively small declines in home prices. This piece of research provided them with the fundamental analysis they needed to understand the vulnerability of these securities.
However, after reading the presentation, they decided to try to short the market. They didn't have a lot of money or a very convincing plan, but they had some ideas about how financial markets worked. Their one idea was to enter private stock markets, where companies are bought and sold, because they are better at pricing things than the public stock markets. In private deals, both sides usually have experts helping them, so the prices are more accurate. Public markets, on the other hand, often have people making decisions based on short-term profits, rather than the real value of a business. Also, the investors in the public market do not look at the bigger picture. For example, an investor in the US stock market only focuses on the US market, and a Japanese market investor focuses only on the Japanese market. Very few people were able to look at the bigger picture and figure out the impact of the Japanese or European market on the US market, and vice versa. So, when they started their firm, Cornwall Capital, in 2003, they wanted Cornwall Capital to find opportunities where the market was not working efficiently, and they planned to do this not just in one type of investment, but in various markets globally, with stocks, bonds, currencies, and commodities. They soon stumbled upon their first big opportunity, a credit card company called Capital One Financial. Capital One was a credit card company that was good at lending money to people with poor credit scores. They were in the business of providing credit cards, not home loans, but they dealt with similar kinds of customers who would later have problems with their home loans. In the 1990s and early 2000s, Capital One claimed to be better than others at figuring out if people with bad credit could be trusted to pay back their credit card bills. They thought they were better at predicting the risk of lending to such people. They had a good reputation in the market because they had survived a tough time when many other similar companies went out of business. However, in 2002, their stock price took a big hit. The market was worried that they might not be as good as they claimed and that they were hiding their financial problems. Some even suspected them of fraud. Regulators were investigating the company, and their chief financial officer resigned. This raised doubts in people's minds. Over the next 6 months, the company still made money, but its stock price stayed low, around $30 a share. There was a lot of uncertainty about the company's true value. Charlie and Jamie researched the situation, talked to people, and even tried to meet with the company's executives. After researching the company, they eventually felt that either the company was run by crooks and was worthless, or the company had strong fundamentals and its stock was vastly undervalued by the market. They believed Capital One's problems with regulators would be resolved in a few months, and its stock would either crash or go up. As the company was going through troubles, its options were priced very cheaply. So, Cornwall Capital bought 8,000 long-term options on Capital One's stock. Their potential losses were limited to the amount they paid for these options, which was $26,000. If Capital One's stock went up, their options would be worth a lot more. And that's exactly what happened. Capital One was cleared by regulators, their stock price rose, and Cornwall Capital's $26,000 investment turned into $526,000. This strategy of buying options on stocks poised for big changes became very profitable for them. It allowed them to make money when they sensed something dramatic was about to happen in the financial markets. They didn't need to know everything about the specific market or assets. They used to hire experts to help them understand the details. They were good at spotting opportunities where the market had misplaced its confidence, and they were not afraid to make small bets with long odds that could result in significant gains. After their success with Capital One, Cornwall Capital had more money to invest. They repeated their success by betting on a distressed European cable TV company called United Pan-European Cable, UPC. They bought call options worth $500,000 at a low price, and when UPC's stock rallied, they made a quick profit of $5 million. Next, they invested in a company that delivered oxygen tanks to sick people at home. Their $200,000 investment quickly turned into $3 million. After this, they named their approach event-driven investing because they were betting on events that could lead to significant price changes. After making significant money, instead of handling their own money, they also thought they needed a good, certified hedge fund manager to handle their money. But whenever they would interview a hedge fund manager and see his portfolio performance, they would get disappointed and think that they themselves were better traders than most hedge fund managers. As these guys were managing their own money, no big bank on Wall Street would want to deal with them. The big banks thought they were too small and just ignored them. But as shown in the movie, with the help of Ben Hawkert, these guys get licenses to bet on bigger deals. When they were first introduced to the Wall Street bond market, they had never traded bonds or mortgages before. So they faced many difficulties understanding the various terms and acronyms Wall Street banks used to address various types of loans and instruments. But the very same thing turned out to be a blessing for them. As these guys were curious, they learned each and every term on their own and studied each aspect of mortgage-backed securities and CDOs. It took them some time to learn, but eventually they figured out that these MBS and CDOs were filled with worthless mortgages. They found more stuff about CDOs, such as that CDO A is a part of CDO B, and CDO B has parts of CDO C, and how messy it was. Then they did exactly the same thing that Michael Burry and Mark Baum did. They started to find which CDOs and MBS were filled with more worthless loans and were most likely to fail. One thing they did differently from Burry and Mark Baum was that they bet against AA-rated CDOs, which even Michael Burry and Mark Baum didn't even think of doing. Their reason behind this was that as all the mortgages were rated falsely by rating agencies, that means BBB-rated bonds and AAA-rated bonds are filled with exactly the same worthless loans. So, if BBB-rated bonds are failing, then AA and AAA-rated bonds are also failing.
I'll bet you right now that those AA's are actually like B's.
The Wall Street traders thought these guys were dumb for betting on AA-rated bonds, but in reality, these guys were geniuses. Further down the line, these guys hired the services of a guy named Bert, who worked for a BlackRock fund that managed $1 trillion. Bert's job was to identify for BlackRock the bonds that were going to go bad before they went bad. When they showed him their bet against AA-rated CDOs, Bert said to them, "You people are the only ones who have bet against AA CDOs." When Bert analyzed their CDOs carefully, he figured out that these guys had inadvertently invested in synthetic CDOs.
Synthetic CDOs.
What did you Synthetic CDOs.
Synthetic CDOs.
That is crazy.
These synthetic CDOs were most likely to fail because they had a swap contract that Michael Burry bought. By January 2007, with their tiny $30 million fund, these guys were putting on bets that were multiples of the capital they had.
It was not just these few guys who were going against the housing market. There was another guy who made the most money during the 2008 crisis. His name is John Paulson, and he made around $26 billion from it. Unlike other people, John Paulson didn't know about the potential crash in the housing market on his own. He himself thought of using CDS to short the housing market. John Paulson made around $4 billion for himself, and his fund made more than $15 billion. That makes him the biggest moneymaker from the 2008 financial crisis. Paulson was a hedge fund manager specializing in mergers. He had no expertise in investing in the real estate market. By this time, Paulson was just guessing the market movement from his experience and instincts. Paulson's big historical profit wouldn't have been possible without his one employee. This one employee had changed everything for Paulson. The name of the employee was Pellegrini. Pellegrini joined Paulson's hedge fund as an analyst at the age of 43. Because of his age factor, he had to compete with other analysts in the firm who were much younger than him and were in their late 20s. So, to stand out against them, and in fear of losing his job, Pellegrini used to work extra hard on the task. But it wasn't working well for him. So, out of competitiveness with his colleagues, and to show extraordinary performance to Paulson, Pellegrini started studying the housing market. When he finished analyzing and presented the results to Paulson, Paulson was impressed, and his conviction that something was wrong with the housing market grew even stronger. The real problem Paulson faced at the time was that he didn't know how to short or bet against the housing market. At that time, everyone thought the housing market was stable and never fell, so nobody cared or even thought about betting against it. Because of that, there was no method or instrument to bet against the housing market.
There are no insurance contracts or options for mortgage bonds. The bonds are too stable.
So, Paulson started to look into buying protection for his firm if all the loans given by the banks started defaulting. He also thought of shorting the shares of some financial companies. But as Paulson would bet, many companies in the business would receive takeover offers, which made the stock price of those companies rise. Because of this, Paulson was looking for a better way to short the housing market. One day, Pellegrini suggested using credit default swaps. It's not like Pellegrini knew everything about credit default swaps. He only watched others trade credit default swaps at his previous job. Paulson agreed to the idea of CDS. Before making a purchase, Pellegrini had to learn everything about credit default swaps. After that, Paulson's fund made its first purchase of CDS. The first few purchases of CDS were a failure for Paulson. After this, Paulson again started to doubt their bet and was looking for another way to short the housing market. But he still kept buying these CDS against these individual companies, which were not doing much for his firm. Most of them were making losses. Actually, Paulson was on the right path, but he was betting on individual companies. Whenever they would bet on any company, if that company was about to fail, then it would mostly get acquired by another big firm, and Paulson's bet would go into losses. Michael Burry, on the other hand, did exactly the opposite, and he had a bet against the mortgage bonds that were made of these bad loans. So it didn't matter to Burry how an individual company was performing, as he knew the underlying loans would still default over time. Because of this, Michael Burry was sure that there was a housing bubble. But Paulson was not sure whether there was an actual bubble. This was because Paulson was unaware of the improper lending practices of the banks. So, Paulson told Pellegrini to study the market more. This time, Pellegrini spent a lot of time analyzing housing market data all the way until 1975. After analyzing the data, he figured out that from 1975 to 2000, housing prices rose by 1.4% each year. But from 2000 to 2005, it rose by 7%. Pellegrini figured out that if the housing market had to crash, the housing prices would have to stop rising and have to fall 40% to reach their real value. A similar analysis and conclusion were made by Greg Lippmann, aka Jared Vennett. His analysis also showed that if housing prices just stopped rising, there would be more than 8% of loans that could default on those MBS bonds, and then the market would fall.
The default rates, they rise to 8%. A lot of these triple Bs are going to 0 too.
You're saying that at 8% the bonds fail and we are already at 4%?
That's right.
If they go to 8, it's Armageddon.
Yeah, that's right.
As people were able to refinance their homes, this made Paulson more doubtful as people would keep refinancing their homes. This would result in housing prices going up continuously. After looking at Pellegrini's analysis, Paulson was sure that the housing market was going to collapse, but didn't know when exactly. And he knew falling home prices would put a quick end to all the mortgage refinancing by subprime borrowers. So, Paulson started to buy huge chunks of credit default swaps. When Michael Burry learned about the CDS demand in the market, he was not worried at all. All he thought was that it would boost the price of the positions he had already taken. Paulson focused on the institutions that had large quantities of subprime or poorly performing mortgages. He shorted New Century, Fannie Mae, Freddie Mac, Citibank, Washington Mutual,
IndyMac, Bear Stearns, and Lehman Brothers mortgage bonds. While making these bets, they focused mostly on the BBB-rated tranches of the bonds. The BBB tranches were cheap. It would cost them only $10 million a year in premium to buy a contract worth $1 billion. When Paulson found out about CDOs, he realized they were also bound to collapse. He shorted the CDOs as well. Paulson wanted to raise funds to do this trade on a very large scale, but he had a really tough time convincing people. His idea was that if he could raise a specific hedge fund dedicated to betting against housing, he could make a fortune. But most investors were still hesitant. Paulson still managed to bet on $25 billion worth of credit default swaps. Paulson had bet $22 million on Lehman's bonds. When they failed, it made him around $1 billion. Paulson held insurance on $25 billion of subprime mortgages. So a 1% downward move in the market meant a 1% profit for Paulson, which was about $250 million. In 2007, as the default rate rose, there was a 5% downward move in the market. With such a fall, Paulson had made $1.25 billion in just a single day. It was more than what George Soros had made with his legendary bet against the British pound in 1992. As the markets fell more, Paulson made even more money with his positions. All of Paulson's investments paid off against the housing market, and John Paulson made for his firm $15 billion in 2007 and another $5 billion in 2008. He personally made $4 billion in 2007 and another $2 billion in 2008. So overall, John Paulson made $26 billion during the 2008 crisis.
Now, one of the crucial things is that all the positions taken by these guys from all the investment banks, the real bet on the other side were taken by AIG. So the investment banks acted as a middleman. For decades, AIG was known for selling traditional insurance policies like car insurance, home insurance, and life insurance. These are things most people understand. You pay a premium, and if something bad happens, like a car accident or a house fire, AIG pays out. It was a reliable, steady business. However, in the years leading up to 2008, AIG ventured far beyond its traditional insurance roots into a more complex and risky area of finance, specifically through a division called AIG Financial Products. This division started selling a type of insurance known as a credit default swap. You know that Michael Burry and others bought these swaps from various banks. For example, Michael Burry bought the swaps from Goldman on some housing bonds. He was expecting that those bonds would fail, and he paid a premium until that happened. But the most important thing here is that Goldman did not have to pay for those swaps. It was AIG that was paying for those swaps. Goldman was just a middleman. Reality was, Goldman bought lots of loans from commercial banks. After they bought those loans, they created an MBS bond product with those loans. Michael Burry studied those MBS bonds, which were created by Goldman. He went to Goldman and said, "Hey, I want to bet money on these MBS bonds you created, because these bonds will soon fail. We should make a swaps contract, and I will pay you a premium for those swaps until these bonds fail." Goldman thought that these are housing bonds, and the housing market never fails. So they thought the premium money was free money for them. Goldman did not take the risk of insuring those bonds themselves. They asked AIG to cover the bonds if they fail. So Goldman went to AIG and asked them, "Hey, Michael Burry wants to bet against these housing bonds we created. Will you insure them and cover the cost if they fail? We will pay a premium to you, too." At the time, AIG also thought that the housing market was never going to crash, and they happily accepted to pay for the swap contracts Goldman sold. AIG has done this with almost all the major banks. So for the majority of the swaps that were bought before the 2008 crisis, AIG was on the other end to cover those swaps. The investment banks only acted as middlemen as people were betting against their MBS bonds. So when homeowners with subprime mortgages began to default, the housing market started to show cracks, foreclosures skyrocketed, and suddenly those AAA-rated mortgage-backed securities didn't look so safe. As the value of these MBS dropped, banks that had bought protection from AIG wanted collateral, a sort of down payment to prove AIG could pay if the losses continued. But AIG hadn't planned for this. The crucial mistake AIG made was in underestimating the risk. They were taking on enormous obligations without fully understanding the potential downside. They didn't set aside enough money to cover potential losses if things went wrong. They were essentially relying on the idea that the housing market would never significantly decline and that homeowners would always make their mortgage payments. At its peak, AIG had insured over $440 billion in credit default swaps. A large portion of it was tied to subprime housing. By mid-2008, it was clear AIG couldn't meet its obligations. The company had already posted over $25 billion in losses, and the worst hadn't even hit yet. Banks that were exposed to AIG started panicking. They essentially said, "Hey, AIG, these mortgage-backed securities you insured are now worthless. You owe money to these credit default swap owners." AIG, which had collected premiums but hadn't set aside enough capital for this catastrophic scenario, suddenly faced billions of dollars in claims it couldn't pay. If AIG collapsed, so would the banks depending on those CDS contracts. That included some of the biggest financial institutions in the world. Think of it like this. Imagine you insured every house in your town against fire, but you only had enough money in your bank account to cover one small house fire. If every house in town caught fire at once, you'd be bankrupt. That's what happened to AIG, but on a massive global scale. On September 16, 2008, just one day after Lehman Brothers filed for bankruptcy, AIG was on the edge of collapse. The Federal Reserve stepped in with an $85 billion loan to keep AIG afloat. This was not a gift, it was a loan, and it came with strict conditions. The government essentially took a large ownership stake in. The initial $85 billion wasn't enough. As the crisis continued and AIG's losses mounted, more government aid was needed. Over the following months, that number grew to $182 billion, making it the largest bailout of a single company in U.S. history. The government basically pumped money into AIG to ensure it could pay its obligations to the banks and other financial institutions. AIG's massive bailout, after the failures of Bear Stearns and Lehman Brothers, solidified a terrifying concept for the American public: too big to fail. It revealed a financial system so interconnected that the collapse of a single, seemingly conservative insurer could bring down the entire global economy. Trillions of dollars in taxpayer money were committed to prevent an even greater catastrophe, sparking outrage and a desperate demand for accountability. To save all these banks, the US government issued a $700 billion TARP program. The government had given money to these banks for liquidity and saved them and many other companies who depended on these banks for operating cost money. Still, banks like Lehman Brothers and Bear Stearns collapsed. All these investment banks had bought lots of these subprime loans to create MBS. So when they realized that they were holding a huge liability, they panicked and started to do a fire sale. The same fire sale you see at the end of the Margin Call movie. To truly grasp the warning signs Wall Street missed and the factors that led to this historic implosion, let's look at the full story of Bear Stearns, from its aggressive culture under leaders like Ace Greenberg and James Cain to its catastrophic final days.
By the mid-2000s, Bear Stearns had become one of the most aggressive participants in the US housing boom. It wasn't just buying and selling mortgages. It owned mortgage originators like the EMC Mortgage Corporation and had direct exposure to the riskiest loans in the market. It packaged mortgages into complex financial products like collateralized debt obligations and mortgage-backed securities. These were sold to investors with AAA ratings from credit agencies, giving the illusion of safety. The firm also created hedge funds that leveraged themselves to buy those products, betting that the housing market would keep rising. When housing prices were going up, Bear Stearns was minting money. The firm posted record profits in 2005 and 2006. James Cain personally became a billionaire on paper during this time. But there was a hidden fragility beneath the surface. Bear Stearns operated with incredibly high leverage, sometimes 33-1. That means for every $1 of its own money, it borrowed $33. This left no room for error. A slight decline in asset value could wipe out its capital. Yet, the firm kept pushing its boundaries. By 2006, cracks had begun forming in the subprime mortgage market.
Default rates were rising, particularly among borrowers with poor credit histories who had been lured into risky adjustable-rate mortgages. But Wall Street, including Bear Stearns, dismissed these as isolated events. They believed housing prices had never declined nationwide. In early 2007, two hedge funds managed by Bear Stearns' high-grade structured credit strategies enhanced leverage fund and its sibling fund began to see impact. These funds had borrowed massively to bet on mortgage-backed securities. When the value of those securities began to drop, the fund's positions turned toxic. By June 2007, creditors started demanding their money back. The funds were forced to sell assets to raise cash, but no one wanted to buy. A liquidity crisis had begun. In a matter of weeks, both funds collapsed. One lost over 90% of its value. Bear Stearns was forced to inject $1.6 billion of its own money into the funds in a desperate attempt to save the damage. This was the first major shock. It rattled investors and drew the attention of regulators and Wall Street insiders. But instead of fully confronting the scale of the risk, Bear Stearns doubled down. James Kane, still CEO at the time, was reported to be playing bridge while the firm scrambled to keep the hedge funds afloat. Behind closed doors, senior executives were in chaos. Kane eventually removed himself from day-to-day operations, and Alan Schwartz was appointed CEO in January 2008. Kane remained chairman but was sidelined. Still, the damage had been done. Even though Bear Stearns was technically solvent in early 2008, trust is the oxygen of Wall Street, and Bear was running out of it fast. The firm's balance sheet showed nearly $400 billion in assets, but only about $11 billion in capital, a razor-thin cushion. Worse, many of those assets were hard to value, like mortgage securities and derivatives. Investors didn't know what Bear was truly holding, and fear began to spread. Rumors of insolvency swirled in March 2008. Counterparties started pulling their money. Clients stopped doing business with Bear. In a span of just 48 hours, the firm went from a functioning investment bank to a crippled institution with no access to cash. On Friday, March 14, 2008, the Federal Reserve stepped in with an unprecedented move: a short-term $12.9 billion loan to keep Bear alive for the weekend. That weekend, emergency meetings took place in Manhattan. The Fed, the Treasury Department, and top Wall Street executives tried to craft a solution to avoid a catastrophic collapse. No one wanted to buy Bear Stearns. The liabilities were too opaque, and the risks were enormous. Finally, J.P. Morgan Chase, with the Fed's guarantee, agreed to purchase Bear Stearns. The J.P. Morgan acquisition of Bear Stearns was controversial from the start. Critics accused the Fed of bailing out Wall Street recklessness with taxpayer guarantees. Supporters said it was necessary to prevent a full-blown financial catastrophe. J.P. Morgan initially offered to buy Bear Stearns at $2 per share, valuing the entire company at around $236 million. It was less than the value of Bear's headquarters building in Manhattan, which was around $1 billion. In this meeting, one Bear executive reportedly screamed, "You've just sold us out for the price of a cup of coffee." Shareholders were furious. In a rare move, J.P. Morgan was forced to raise the offer to $10 per share. It was still a 93% discount from the stock's peak. The Federal Reserve, in an extraordinary intervention, agreed to back $29 billion of Bear Stearns' toxic assets just to make the deal happen. With this move, Bear Stearns, an 85-year-old institution, was gone. Employees were informed over the intercom that J.P. Morgan is now your new employer. The fall of Bear Stearns in March 2008 was more than just the demise of one firm. It was a warning that many on Wall Street tragically dismissed as an isolated incident of poor risk management. They were wrong. Just 6 months later, in September 2008, the catastrophic collapse of Lehman Brothers happened. At the turn of the millennium, Lehman Brothers was thriving. By 2000, the firm had established itself as a dominant player in the global financial markets. It focused on investment banking, fixed income trading, equity, and asset management. Lehman had survived the 1998 Russian financial crisis and the collapse of long-term capital management, which had destabilized financial markets worldwide. This survival fueled the firm's confidence, prompting it to explore new avenues for profit in the early 2000s. Lehman, like many other Wall Street firms, began pouring money into the booming housing market. They aggressively expanded its mortgage securitization business and acquired mortgage lenders such as BNC Mortgage and Aurora Loan Services, which specialized in subprime and high-risk mortgage products. Lehman also became one of the largest underwriters in mortgage-backed securities, packaging thousands of mortgages into tradable securities. Between 2003 and 2007, Lehman's mortgage-related securities portfolio grew exponentially. It was a significant portion of its revenue. During this period, Lehman generated billions in profit, with its stock price surging to an all-time high of $86 per share in February 2007. At that time, the firm seemed unstoppable. Lehman's strategy was simple: capitalize on the booming housing market by issuing, packaging, and selling mortgage-backed securities. However, the firm's aggressive expansion into subprime mortgages and risky real estate ventures exposed it to unprecedented levels of risk. By 2006, Lehman's real estate holdings had increased to over $100 billion, making the firm highly vulnerable to any downturn in the housing market. Despite warning signs that the housing bubble was beginning to burst, Lehman doubled down on its real estate investments. Richard Fuld, Lehman's long-serving CEO, was a strong believer that the firm's position was strong enough to weather any storm. Fuld, who had led Lehman since 1994, was known for his aggressive leadership style and an unwavering belief in Lehman's resilience. Under his leadership, Lehman's appetite for high-risk, high-reward ventures only grew stronger. By mid-2007, the U.S. housing market was in trouble. Home prices had begun to fall and defaults on subprime mortgages were rising. In June 2007, Bear Stearns, another major Wall Street firm, announced the collapse of two of its hedge funds that had invested heavily in subprime securities. This was the first clear sign that the subprime crisis was spiraling out of control. Despite these warnings, Lehman continued to reassure investors that its exposure to the subprime market was manageable. In fact, the firm increased its exposure to mortgage-related assets, believing the market would stabilize. By late 2007, Lehman was sitting on a mountain of deteriorating assets, but the true extent of its exposure was hidden behind complex accounting maneuvers. Lehman used an accounting trick known as Repo 105. It was an accounting technique used by Lehman Brothers to temporarily remove billions of dollars of assets from its balance sheet, giving the illusion that the firm was healthier and less leveraged than it actually was. This practice played a significant role in misleading investors and regulators about the true state of Lehman's financial health in the months leading up to its collapse in 2008. How Repo 105 worked. A repurchase agreement, repo, is a form of short-term borrowing where a financial institution sells securities, such as bonds, to another party with the agreement to repurchase them at a slightly higher price after a short period. Let's see an example of how Repo 105 works. Let's say Lehman Brothers had $50 billion worth of risky mortgage-backed securities on its balance sheet. These MBS were losing value as the housing market collapsed, and Lehman wanted to temporarily reduce its reported debt. So, Lehman sold $50 billion worth of these securities to another bank, such as a European bank. The sale was structured at 105% of their value, which meant the accounting standard required to classify the deal as a sale rather than a loan. So for this transaction, Lehman received $47.6 billion in cash from a European bank and reported the deal as a sale of MBS rather than a loan. This removed the $50 billion of risky assets from its balance sheet. As the quarter ended and when Lehman's financials were reported to the public, then Lehman would repurchase the securities at 5% higher cost for $50 billion, bringing the debt back onto its balance sheet. As the financial statements for the quarter had already been published and Lehman had successfully cleaned up its books for that quarter, by removing liabilities from its balance sheet at critical reporting periods, Lehman misled investors and regulators about its true financial condition. This gave the false impression that Lehman was more solvent and less risky than it actually was. As 2008 began, the global financial system was on the brink of collapse. Lehman's losses increased exponentially as the housing market continued to deteriorate. In the first quarter of 2008, Lehman reported a profit, but by June, the firm posted a $2.8 billion loss. It was its first quarterly loss since going public in 1994. This was followed by an even bigger loss of $3.9 billion in the third quarter of 2008. As Lehman's situation worsened, the firm was desperately looking for a buyer to rescue it from collapse. Fold and Lehman's management approached numerous potential buyers, including Bank of America and Barclays, but none were willing to acquire Lehman's massive liabilities without government assistance. In mid-September 2008, U.S. Treasury Secretary Henry Paulson, Federal Reserve Chairman Ben Bernanke, and New York Federal Reserve President Timothy Geithner convened a series of emergency meetings with Wall Street executives to try and broker a deal to save Lehman. However, unlike in the case of Bear Stearns, which had been bailed out by the government earlier that year, Henry Paulson was adamant that no public funds would be used to rescue Lehman Brothers.
You did it for Bear.
We are not bailing out Lehman. Wall Street has a gambling problem. The government keeps covering their losses. They never learn anything.
Bank of America was initially interested in acquiring Lehman, but instead, it opted to acquire Merrill Lynch, leaving Lehman without a lifeline. Barclays expressed interest, but ultimately backed out due to regulatory concerns and the lack of government support. Barclays wanted to save Lehman and asked Warren Buffett to cover the cost for a while, but they couldn't have proper communication at the time as Warren Buffett was traveling and the deal couldn't go through. So, on the morning of September 15, 2008, after a weekend of frantic negotiations, Lehman Brothers filed for Chapter 11 bankruptcy protection. It was the largest bankruptcy in U.S. history. Lehman had $639 billion in assets and $619 billion in debt. The collapse sent shockwaves through the global financial system, triggering a panic that led to the worst financial crisis since the Great Depression. Just after Lehman, Goldman Sachs was also on the verge of bankruptcy. But by doing some crucial changes at the last moment, and with the help of Warren Buffett, they managed to save themselves. After Warren Buffett's backing at a crucial point during the crisis, Goldman managed to keep the trust of the investors. Overall, Goldman was saved by Warren Buffett. By the early 2000s, Goldman had become a global powerhouse. The firm was known for hiring the smartest minds and giving them the freedom to take bold, calculated risks. But this same aggressive culture also led Goldman to make some very questionable moves during the housing boom. For most of its history, Goldman Sachs was a private partnership. This meant the top people, the partners, owned the company and invested their own money in it. Becoming a Goldman partner was like reaching the very top of Wall Street. It meant incredible wealth and status. This system made partners very loyal who focused on the firm's success. But as Goldman grew huge and needed more money for its global trading business, many of Goldman's partners wanted to cash out their shares, so the company decided to change. In 1999, Goldman Sachs became a public company. Their IPO raised billions of dollars, giving Goldman even more firepower for trading and expanding. But it also meant Goldman now had to answer to public shareholders every 3 months and constantly worry about its quarterly profits. This changed the company's culture, making it focus more on short-term profits. When the 2000s began, Goldman Sachs was led by CEO Henry Hank Paulson, and then, from 2006, it was led by Lloyd Blankfein. During this period, Goldman was arguably the most powerful and profitable investment bank in the world. Its trading desks were making record-breaking profits. Goldman's role in the housing boom. Like many other Wall Street firms, Goldman Sachs was heavily involved in the mortgage-backed securities market. Investors purchased these MBS, complex financial products that bundled thousands of home loans. As the housing market boomed, Goldman created and sold billions of dollars worth of mortgage-backed securities and collateralized debt obligations. These products were incredibly profitable and allowed the firm to make a lot of money quickly. Goldman not only sold these products, but they also bet against them. Initially, the firm had a large amount of exposure to subprime mortgages through the securities it created. But by 2006, some executives inside Goldman began to see cracks in the housing market. This is where Goldman made a key move that separated them from firms like Lehman Brothers. They began reducing their exposure to mortgage-backed securities and started placing bets against the very housing market they had helped inflate. Between late 2006 and early 2007, Goldman Sachs quietly started to offload around $10 billion worth of toxic CDOs. These were the similar CDOs that brought down Lehman Brothers, Bear Stearns, and almost the entire financial system. Goldman's move to get rid of these CDOs wasn't random. According to internal emails and memos released during the SEC investigations, key executives were actively warning that the housing market was overheated and about to collapse. One famous internal email from a top executive read, "This market is toast." That quote was later repeatedly cited by the media and investigators. After offloading, Goldman began aggressively shorting the housing market using credit default swaps, similar to what Michael Burry was doing. In The Big Short, Michael Burry was shown having major conflicts with Goldman Sachs and other banks. He accused them of not making his positions to market, that is, not giving him the real-time value of his credit default swaps. This was not a coincidence, because Goldman was also taking large short positions against the housing market. While they were facilitating Burry's trades, they were also using the same CDS contracts to protect themselves and possibly to profit. The delay in marking Burry's positions correctly was a strategic move to buy time while Goldman built their own hedges and offloaded their toxic positions. During this period of late 2006 to early 2007 is when the firm pivoted aggressively. They transitioned from being a net long player in the housing market to a net short. Basically, they were betting against the same clients they had sold the toxic CDOs to. The Abacus Scandal. One of the most famous CDO deals of Goldman was the Abacus Scandal. This was a synthetic CDO deal where Goldman allowed a hedge fund, Paulson and Company, to select the underlying mortgages that Paulson believed would fail. Paulson then shorted the CDO, while Goldman sold it to other investors like ACA and a German bank called IKB. When the mortgages underlying the CDO began to fail, Paulson made over $1 billion in profits, while investors lost massive amounts of money. Goldman didn't tell the investors that Paulson had played a role in choosing the assets. This led to a major SEC investigation and a $550 million fine, the largest penalty against a Wall Street firm at the time. While Goldman didn't admit to wrongdoing, the damage to their reputation was significant. As the financial system started to collapse in 2008, firms like Lehman Brothers, Bear Stearns, and AIG were either going bankrupt or required government bailouts. Goldman Sachs was in a precarious position too, but their earlier move to short the housing market gave them a crucial buffer. According to reports, Goldman made nearly $4 billion from its short positions in 2007. This profit helped cushion the blow when the market completely tanked in 2008. However, by September 2008, things had gotten so bad that even Goldman Sachs was at risk. Their stock was plummeting. Counterparties were nervous. The whole system was grinding to a halt. Before the 2008 crisis, Goldman Sachs was an investment bank, meaning its primary business was to serve large institutions, corporations, and high-net-worth clients through activities like trading, investment management, underwriting securities, and complex derivative deals. Investment banks don't deal with ordinary customers like traditional banks do. They don't accept savings deposits or offer personal loans. Because of this, they're not tightly regulated by the Federal Reserve. Instead, they fall under lighter oversight, which gives them flexibility to operate with higher leverage and take on more risk. But this freedom comes at a cost. When a financial crisis hits and credit dries up, investment banks don't have a safety net. They can't borrow money directly from the Federal Reserve like commercial banks can. So, when Lehman Brothers collapsed in September 2008 and the markets seized up, even a powerhouse like Goldman Sachs faced a serious threat. How do you fund your operations when no one wants to lend and panic is spreading? That's when Goldman made a bold, strategic decision. It applied to become a bank holding company, BHC. So, what exactly is a BHC? A bank holding company is a type of corporate structure that owns or controls one or more commercial banks. Think of it as a parent company for a regular bank like JP Morgan Chase & Company or Bank of America Corporation. When a company becomes a BHC, it agrees to submit to strict oversight by the Federal Reserve, including tight capital and liquidity requirements, stress testing, and limits on risky activities. In exchange, it gains access to critical support mechanisms, namely the ability to borrow directly from the Fed's discount window, a last resort line of funding to keep the institution liquid during times of distress. By converting into a BHC on September 21, 2008, Goldman Sachs essentially said, "We are willing to give up some of our freedom to survive." This gave them access to a more stable source of funding and also reassured investors and counterparties that the Fed had now stepped in as a watchdog. It sent a message to the market that Goldman wasn't flying solo anymore. The Federal Reserve had its back. That trust, in the middle of a global panic, was priceless. Just 2 days after becoming a bank holding company, Goldman Sachs secured another lifeline, this time from none other than Warren Buffett. On September 23, 2008, Buffett's company, Berkshire Hathaway, announced a $5 billion investment in Goldman Sachs. This wasn't a charity act. It was a calculated, high-reward bet. But more importantly, Buffett never would have made this deal if Goldman hadn't become a bank holding company. Why? Because before the collapse of Lehman Brothers, Buffett was approached to invest in Lehman too, and he said no at that time. The reason was simple. Lehman was highly leveraged, unregulated, and didn't have access to the Federal Reserve's safety nets. It was too risky and too opaque, and Buffett didn't trust the numbers. Goldman, on the other hand, had just voluntarily submitted itself to tighter Fed regulation by becoming a BHC. That gave Buffett a level of confidence. He knew Goldman now had access to emergency funding from the Fed. It was a vote for stability, and that's what made the investment make sense. Warren Buffett's deal was structured in such a way that it benefited him massively. He purchased $5 billion worth of preferred shares, which are a special kind of stock that pay a fixed dividend. In Buffett's case, that dividend was annually 10%, meaning he would earn $500 million every year just for holding the shares. Now, compared to the average dividend yield investors were getting in the market back then, it was just 2 to 4%. Many companies had stopped paying dividends altogether due to the financial meltdown. In a world where trust was gone and cash was king, a guaranteed 10% return on $5 billion was unheard of. It was essentially a high-interest loan dressed up as an investment, and Buffett structured it so that he got paid handsomely while taking on less risk. This wasn't a bailout out of goodwill, it was a classic Buffett move. Bet on a strong brand when the world is panicking, but only if the terms are heavily in your favor. Plus, he got warrants to buy another $5 billion of Goldman's common stock at just $115 per share over 5 years. That means even if Goldman's stock price rises in the next 5 years, Buffett will buy at a discounted price of $115. But with Buffett, what Goldman really got wasn't just money, it was credibility. When the world's most trusted investor backs you during a financial meltdown, it signals that your business is sound and worth saving. The very next day, Goldman raised another $5 billion through a public stock offering, now with investor confidence on their side. The twin moves of converting into a BHC and securing Buffett's investment gave Goldman Sachs the oxygen it needed to ride out the worst financial storm of the century, while others like Lehman were left gasping for air. While the institutions were saved at immense public costs, the question lingered, who was truly responsible? And beyond corporate entities, were any individuals held to account for the reckless decisions that led to such devastation? Despite the widespread fraud and negligence, only one major Wall Street banker was ultimately jailed for his role in the crisis. Now, such a big event has happened in which you can see many bankers and people from the government might be involved, or their carelessness cost trillions of dollars lost. So, many bankers might have faced jail time for causing such a big crisis. The reality is completely different. Only one banker went to jail for minor charges, and now he is free. His name is Kareem Sarageldin. He was a managing director and global head of structured credit trading at Credit Suisse. He was sentenced to 30 months in prison in 2013 after pleading guilty to conspiracy to falsify books and records of a financial institution. He was caught mismarking the prices of subprime mortgage-related bonds in Credit Suisse's trading book in late 2007 and early 2008 to hide losses. This was done to make the bank's assets appear more valuable than they actually were, concealing the true extent of their exposure to toxic assets as the market was collapsing. The singular case of Kareem Sarah-Geldon underscored a frustration for the American public. Despite widespread recklessness, fraudulent practices, and the near collapse of the global economy, nobody took serious accountability for the 2008 financial crisis. This caused public outrage and a fierce debate about the fundamental fairness of the financial system. It became clear that simply bailing out banks wasn't enough. Fundamental reforms were needed to prevent a recurrence. After the crisis, the government faced huge criticism for bailing out these bankers. In 2010, the government implemented the Dodd-Frank Act as a direct response to the 2008 financial crisis. Its primary goals were to promote financial stability, end too big to fail through mechanisms for orderly liquidation, protect consumers from abusive financial practices, and increase accountability and transparency across the financial system. After the crisis, all the people who profited from the crisis, most of them, went out of public life. Let's see where these people are now, 17 years after the crisis in 2025.
Ben Rickards. Ben Rickards' character was based on a Deutsche Bank trader, Ben Hockett. He helped Cornwall Capital get an ISDA that allowed them to bet against the housing market with the help of credit default swaps. His strategic positioning led him to substantial profits when the housing market collapsed. After the crisis, Ben Hockett has chosen to distance himself from Wall Street. He moved to Berkeley Hills to trade derivatives from the comfort of his home. He wanted to stay close to his family and far away from the Wall Street culture. Hockett's current residence is inaccessible by car. He craves seclusion and self-sufficiency. This characteristic was highlighted by Brad Pitt's character in the movie as well. As of 2024, Hockett maintains a low public profile. His post-2008 activities are largely unknown due to his deliberate retreat from public and professional limelight. While Hockett chose a life of seclusion, others continue to make waves in finance, like Jamie Mai and Charlie Ledley. These two guys were the geniuses who turned their $110,000 into $80 million. Their remarkable transformation of $110,000 into $80 million is a must-watch. Check it out here. After the crash of 2008, Charlie Ledley left Cornwall Capital but not the world of finance. After that, he joined Highfields Capital Management in 2010. Highfields Capital Management is a value-oriented investment management firm that manages private investment funds of various organizations, such as charitable and philanthropic foundations, pension funds, and other institutional and private investors. Jamie Mai is still with Cornwall Capital, where he serves as the CEO and the Chief Investment Officer. He's also a chairman of the board of a forest products and land management company. The Tobin Project, which focuses on academic research, has both Charlie and Jamie as board members. They both also helped the actors of the movie while shooting The Big Short. One of them even visited the set of the movie. Though Jamie Mai made huge profit from the crash, he was deeply disheartened by the crash and was really disappointed that no one in the big banks was ever held accountable or faced any consequences. Greg Lippmann. After the crisis from 2008 to 2010, Greg continued to work at Deutsche Bank itself. During this period, Lippmann continued to lead Deutsche Bank's asset-backed securities trading division and managed a team of professionals in New York and London. In April 2010, Lippmann left Deutsche Bank. In October 2010, Greg Lippmann co-founded LibraMax Capital, a hedge fund specializing in structured credit products. He is a CIO and chairs the firm's investment committee and especially focuses on its risk management strategies. His fund has around $8.5 billion under management and gives an 8% annual return. Even after the 2008 crisis, Greg Lippmann was very vocal about the potential risks in the financial markets. In 2018, he expressed concerns about corporate debt, suggesting that it could pose challenges similar to those experienced during the subprime mortgage crisis. He still focuses on benefiting from market inefficiencies like he did during the 2008 crisis. His focus is on designing portfolios strong enough to handle high interest rate environments.
He advocates for investing in underpriced commercial mortgage-backed securities, particularly those that are considered medium or bad. This way, he can capitalize on market inefficiencies. Lippmann occasionally engages in public interviews and shares his thoughts on the current market situations. People highly value his deep understanding of credit markets. Eisman. After the crisis, Eisman continued his role at Front Point Partners. His strategies during the financial crisis yielded significant profits, which enhanced his reputation in the industry. In 2008, Eisman left Front Point Partners following the firm's challenges, including insider trading allegations against another employee, which led to investor redemptions and operational difficulties. In 2012, Eisman founded MBS Partners, a hedge fund focused on long-short equity strategies, particularly within the financial services sector. Despite initial high interest from investors, MBS Partners faced performance challenges, because of which Eisman closed the fund in 2014. In September 2014, Eisman joined Neuberger Berman as a managing director and portfolio manager. At Neuberger Berman, Eisman continued to leverage his expertise in financial services, providing insights into market trends and investment strategies. Eisman also appears in interviews occasionally to comment on financial markets and share his perspectives. Michael Burry. After the financial crisis, Burry closed his hedge fund, Scion Capital, in 2008 to focus on personal investments. In April 2010, Burry wrote an editorial article for the New York Times, in which he criticized federal regulators for ignoring warnings about the subprime mortgage market's risks. Around the same time, Burry was audited by the IRS, and he also gave testimony to the FCIC, a government organization for Financial Crisis Inquiry Commission. Burry found the testimony to be an intimidating experience, as he had criticized the financial system in his blogs.
In 2010, I published an op-ed in the New York Times posing what I thought was a valid question of the Federal Reserve, Congress, and the President. I saw the crisis coming. Why did not the Fed? Never did any member of Congress, any member of government for that matter, reach out to me for an open collegial discussion on what went wrong or what could be done. Rather, within 2 weeks, all 6 of my defunct funds were audited. The Congressional Financial Crisis Inquiry Commission demanded all my emails and lists of people with whom I had conversed going back to 2003, and a little later the FBI showed up. $1 million in legal and accounting costs and thousands of hours of time wasted, all because I asked questions.
In 2013, Burry reopened the hedge fund but rebranded it as Scion Asset Management and appointed himself the manager. The fund focused on various investment opportunities, including water, gold, and farmland. His 13F filings are constantly analyzed by investors around the world to learn more about Burry's strategy. His 13F filings revealed that Burry has a diversified investment approach with assets under management exceeding $100 million. As Burry is known for finding market bubbles, in 2019, Burry warned of a bubble in large U.S. company stocks due to the rise of passive investing, suggesting that smaller value-type securities were being overlooked. In 2019, Burry invested in GameStop stock. Burry recognized that GameStop was undervalued. The company owned a significant amount of physical retail locations, real estate, and had a strong brand despite the decline in its core business. He believed the company had a chance for a turnaround. Burry noticed that GameStop was heavily shorted by institutional investors. He saw the stock's price as unjustifiably low. His bet was on the idea that the market was underestimating the company's value, especially with its vast real estate holdings and the possibility of management turning things around. Burry started purchasing shares of GameStop in 2019 when the stock was trading at around $4 per share. His firm accumulated a significant stake in the company. In 2020, just before the GameStop stock saga, Burry sold his positions when the stock was around $20. But he still made upwards of $100 million from that trade. If Burry had anticipated the retail-driven surge of GameStop to $480, he could have made billions instead of $100 million. Burry also had taken the short positions against Tesla in 2020, which he closed in 2021. In 2023, Burry made a huge headline by making a short position indicating a decline in the stock market, but later he closed his positions. After the crisis, Burry has made predictions many times, but they did not come out true or partially true. The reason for this is his popularity on Wall Street. Not only do people analyze his investment portfolio trying to figure out his agenda, but they also analyze whatever he says. So his early prediction is used as a safeguard, making the prediction become true. Overall, after 2008, Michael Burry has maintained his reputation as a contrarian investor, making bold and often controversial market predictions. His investment strategies continue to attract significant attention, reflecting his enduring influence in the financial sector.
The 2008 financial crisis reshaped not only markets and regulations, but also our understanding of risk, greed, and the profound interconnectedness of the global economy.